Banks on a tear. You got 10-year yield lower, under 2.4%. You have buying across the curve. How do you buy banks with the yield falling?
What I would suggest is that investors are looking out over the next 12 months because, as we know, since the financial crisis, the banking sector is one of the most oppressed sectors within the S&P from a regulatory standpoint. And there are some big changes coming to the regulatory environment for the banks over the next 12 months. In addition to that, if the economy responds to the Trump administration's economic policies, as many people expect it will, we will see higher rates. That's the reason people are buying the banks.
All right, but look at JPMorgan stock is up 113% since the financial crisis. I mean, how much more juice are we going to squeeze if we roll back some regulation there?
It's a good question, and it's a question investors are wrestling with all the time. But what we would point out is that one of the biggest areas for JPMorgan, as well as the industry, that has been under assault since the financial crisis is the net interest revenue line. Net interest revenue, of course, is generated from the yields on their assets less the cost of their funding of those assets. And if rates rise and the yield curve remains this steep for the next 12 to 18 months, this area, which used to, for the industry, generate about the spread this is, it was about 3.7% 10 years ago. It's currently now under 3%. So as this rises, profitability will go up for JPMorgan and others.
So which bank is best positioned for that kind of scenario?
Bank of America is positioned the best for that scenario for rising rates. It's obviously also a play on the U.S. economic expansion, and that is a name that investors are looking at. And that stock, as you know, is up over 100% over the last 52 weeks.
And now, which stock is reflecting optimism that we're not going to actually see reality?
It's difficult right now to identify those names because the rising tide will lift all ships with the banks. Think about it for a moment. If interest rates is the primary driver of the bank increased profitability, which we believe it is, it's going to affect all the banks favorably because all the banks will benefit from wider spreads. So it's hard to identify somebody that's going to be, the fish that doesn't swim with the school. We would say it's all the banks are going together, and it's tough to identify somebody that won't join those other banks.
And David, I should point out that we have seen stocks roll over a little bit. JPMorgan now negative on the day, off by 0.1%. So a brief moment of optimism there at 9:30.
It's gone. Oops,
and then
it's
moving
gone.
a little bit, but nonetheless, we're still trading right around those record levels.
So, Gerard, it may be swimming the school, but is Wells Fargo a little bit behind the school because of all the difficulties it's been having?
That is correct. The Wells is certainly the laggard, and you've identified the one that if one wanted to look at a bank that hasn't done it as well as the other large banks, certainly it's Wells Fargo because of the issues they're dealing with their consumer banking practices. Over time, those issues will be resolved, but certainly that is a stock that has certainly lagged, no doubt about it.